everyone, good evening. It's 5 p.m. on the clock, which means it's time to kickstart our Rise with India prime time on ET Now. I'm Mubina Kapasi and this is the Money Show, the first show on RWI prime time, where we talk about how you can get rich using mutual funds, how you can protect your money with insurance, how you can save taxation, and of course, how you can spend your money, enjoy life, but do it wisely. That's what the Money Show is all about. And we have a whole host of topics lined up for you over the course of the next 1 hour. First up, corporate fixed deposits. Now, I'm sure you guys must be wondering that we've heard of bank fixed deposits, but now what are corporate fixed deposits? Well, as the name suggests, it's basically when you can deposit money with a corporate as opposed to a bank and they will pay you interest. It works in the same manner as a bank fixed deposit, except that it's a corporate that gives you that interest amount, and it usually is higher than a bank fixed deposit. So, is it a good idea then to invest in these corporate fixed deposits because they seem to be giving out a better return than bank fixed deposits with more than 8% if you invest in 12 months, for 12 months rather. So we will try and understand what exactly corporate fixed deposits are, what you should look after when you do select a corporate fixed deposit. That's what we have lined up on the show. We'll also then be taking on board in our second segment a discussion on bank merger. Now, while a lot has been spoken about how, the PSBs are getting merged, Canara and Syndicate are getting merged, Union Bank is getting merged with another bank, so on and so forth. The question is that if you, our viewer, is holding a savings account, a fixed deposit account, credit cards, debit cards, ATM cards, checkbooks of these banks, what should you do then? I mean, should you wait for a new set of paraphernalia, as we call it, from the merged bank? Will you be able to carry out banking transactions? And if not, or if the merger is happening in a particular date, by when will you be able to complete transactions? All of these nitty-gritties with respect to banking operations as well will be discussed. And remember that since these PSBs are getting merged and a couple of banking employees are not exactly happy with this decision, they are going to go on strike. So there will be certain services that you may not be able to utilize. So we are going to give you a holistic approach as to how you can deal with the strike, what services will be available, what will not be available. And also we'll be giving you a review of the LIC Tech Term Plan as well as some big voices from the Morningstar Conference. It's a jam-packed show, like I have been telling you on the show menu. But before we kickstart the Money Show, here's a quick look at the big headlines at this hour. The government, FM Nirmala Sitharaman, announces a ban on production, export, import and distribution of e-cigarettes. FM Sitharaman says the move will protect youth and children from the risk of addiction through vaping. The budgetary impact is pegged at a little over 2,000 crore rupees. But it's not just that. The cabinet also approves 78 days of bonus for railway employees. The GDP pain could last for at least another quarter, says Niti Aayog Chief Amitabh Kant. In an exclusive chat with ET Now, Amitabh Kant adds that GST collections may only pick up after a period of roughly 6 months. Also adds that global tariff war should be viewed as an opportunity to scale up exports. In his first interview after taking charge as Power Secretary, Subhash Garg says supply disruptions due to monsoon will be restored in this month. Also adds that if power discoms resolve payment issues, demand could pick up pace. Crude oil guru Dr. Feridun Fesharaki says oil supply disruption and price volatility is only in the short term. Speaking exclusively to ET Now, global crude expert says that if Saudi is unable to restore normalcy by November, oil prices could hit $70 per barrel. It was a day of range-bound trade on Dalal Street after yesterday's turmoil. Sensex edged 83 points higher, with Tata Steel being the top Nifty and Sensex gainer. Interestingly, except pharma, all other sectoral indices ended in the positive, led by metal, IT, infra, energy and auto. But despite the fall, Nifty is still in the negative for 2019. The Supreme Court pulls up the centre for not being able to stop manual scavenging, says we cannot send people to die in a gas chamber. Making scathing observations in the case, top court wraps the centre for failing to provide protective gears and oxygen cylinders, leading to 4 to 5 deaths every month. Okay, those were the top headlines at this hour. But as promised, first up on the Money Show, we are going to be talking about corporate fixed deposits. Like I told you earlier, it's just like a bank fixed deposit, but the only difference is that you will be putting your money, instead of a bank, you will be essentially putting it with a corporate. They as well will be paying you that fixed rate of interest, but it is going to be higher as opposed to that of a bank. So it does tend to provide a lucrative return option, especially at a time when, well, mutual funds aren't exactly giving the best returns, and bank fixed deposits as well, the returns over there may be going lower because, well, the RBI governor is reducing interest rates. So the question is this indeed a lucrative option where you can park your money in? Let's discuss this with Tarun Birani, founder and CEO of TBNG Capital Advisors, who is at this point of time stuck in the Mumbai traffic and rains. But Tarun, nevertheless, thank you for joining us via FaceTime. And let's start with this discussion on essentially these corporate fixed deposits. We have had a whole host of them: Bajaj Finserv, Bajaj Finance, Hoodco, HDFC, even Hawkins, and some of their returns are in excess of 8% for the lowest time period. So is this a good option for our individual investors to consider putting their money in, as opposed to maybe a plain vanilla bank fixed deposit?
Yeah, so thank you for having me here. First of all, let's just quickly understand what a corporate fixed deposit is. Corporate fixed deposit are normally issued by the NBFCs as well as the manufacturing companies. These deposits offer a higher rate of interest compared to normal fixed deposit, as the risk involved compared to a normal fixed deposit issued by bank is higher. So one need to be very clear that if somebody is giving you higher returns, it is coming at a cost of some additional risk. Since the risk involved in a corporate fixed deposit will be higher, so there is a default risk where the company might not be able to return the maturity amount to the customer at maturity. This normally happens when the company may go for a bankruptcy in future. Yeah. Apart from that, recently we had a case study of DHFL where we have seen a lot of turbulence, as well as we have seen a lot of repayment schedules have been changed and everything. So my assessment is, one cannot only look at a AAA option and just invest in a corporate fixed deposit. The corporate fixed deposit requires a very detailed research, like equity research, and this due diligence is required, similar to buying a normal stock. Along with the credit rating, you need to look at factors like fundamentals of the company and its management. Only if they are sound, we should put money in that. And those who don't have the wherewithal to go through that, I would strictly recommend them not to look at corporate fixed deposit. I hope I was able to clarify.
Yes, good point, Tarun, because sometimes the lure of that more than 8% return, which a lot of these corporate fixed deposits are offering, is quite high, but it's interesting, Tarun, that you say that it requires the same kind of research that an individual stock would require if you're investing in that for the long haul, as is the case even for a fixed deposit. So Tarun has a strong no for individual viewers who may not have the wherewithal or even the time for that matter to get into such in-depth research. So Tarun, then let's assume that if I'm your average individual investor, I have my money in mutual funds and SIPs, but I have a job of my own, right? I'm not completely and entirely devoting my time to sort of investing and to stock markets, and hence I invest in a mutual fund because there's a fund manager. In such a scenario, should I completely shun corporate FDs and look only for a bank FD? Would you recommend that for a person like me who has a salary, who has a salaried job and is busy in other things in life as opposed to share markets and stuff like that?
Right. So I'm a very strong believer of investing based on suitability. It's very important for us to understand what is suitable for us. Like, we need to be very clear what is the goal and objective of that investing. I have normally observed that most of the investor invest very randomly. They just invest based on the market sentiments. I don't think that's a very good idea to invest. Everybody needs to create a blueprint for themselves based on their current situation, current goals, as well as their personal finances, and based on that they need to figure out what is the directional call they want to take with their finances. Once that is set up, I think the investing options become much more clear. For example, let's say if you have a short term requirement, you need to there are a lot of options available where one can look at. There are options like liquid fund. There are options like keeping money in your bank FD, short-term bank FDs. There are a lot of options available for that. If we are looking at a medium-term options, there are options like hybrid structures also could be looked at. For long-term, there are equity, real estate, and a lot of options available. So my suggestion is, rather than painting the town blue based on these sentiments, one should look at their suitability, and basis that there are loads and loads of options available. Corporate FD is also one very good option available, but that requires some bit of due diligence. That is the only limited point I want to make.
Well, yeah, corporate FDs is just one product in a whole sea of products and innovation that the financial industry has come out with. So if you don't have the where and withhold to sort of research extensively, just go for one of the other options. Even a plain vanilla fixed deposit, not that bad. There's no credit risk over there, or at least the credit risk is minimal. So, there's no fear on that regard. Yes, you may not get as, that higher return, but hey, the risk as well is lower. Okay, I just had a follow-up question, but, we have Ask the Money show going on. So let's get on board some questions and queries from our viewers. We have Samir joining us on the phone line from Mumbai. Hi, Samir. Morning. Good evening, rather. What's your question?
Hi. My question is, like, if you talk about the corporate fixed deposits,
Yes.
are they totally subject to market risk? For example, if I get a corporate FD for a period of 1 year,
Right.
and I'm supposed to get an interest of 10%,
Right.
10%, okay? So is it subject to market risk, or am I eligible to get a 10% interest on the particular amount which I
So
have?
basically, you're asking if it's fixed, that 10% if it's
like
as
a
if it's
bank.
fixed. Like a bank, okay.
Yeah, but in bank, it's not subject to market risk.
Exactly. Yes. Okay. So like we said, very similar to a bank FD. But yes, again, Tarun, if you could just clarify for Samir, if it is, if he has bought that FD at 10%, will he get that 10%, or will it be subject to market risks?
Thank you, Samir, for this question. I think your question is very simple, but the question which you asked, that whether the market risk will be involved in that part. Yes. First of all, we need to understand what is debt and equity. Debt is something where there is a fixed return coming in, and equity is something which is like you become an owner of a company. So unlike a equity kind of risk, debt doesn't have that kind of risk. But tomorrow, let's say the company goes for a default or bankruptcy. In that case, the debt holder interest repayment and all those things also goes for a toss. So in that limited way, that market risk is there. But you will, if the company remains solvent, they will continue to keep paying you interest. So in that way, it is different from equity. I hope I was able to clarify.
So, Samir, basically when you have bought that fixed deposit with a corporate at 10%, you've essentially lent money to the corporate and they have to pay you 10% interest. Now, regardless of what happens in the market, they have to pay you 10%. But of course, if the company goes belly up and says, hey, I have no money in my bank account and, to all my creditors, sorry, you're not going to get anything, then well, that's going to be your loss, and that's going to be a situation where credit risk comes about, where they will not even be able to pay you 10%, leave alone the maturity of your deposit. So that's the only risk you'll have to deal with. But yeah, you will get the 10% interest provided the company is solvent. That 10% number will not waver. So that's essentially similar to a bank FD in that way. By the way, here are some corporate FDs as well that are currently in the market as per Paisa Bazaar. Of course, the exact rate will depend on what's the tenure of your FD, but these are just some examples. You have a Mahindra FD, Mahindra Finance FD that's 8.75%, Bajaj Finance 8.4. It's interesting to note there's the Hawkins cooker. Hawkins pressure cooker, that's literally that consumer company, that is offering an FD for 10.75%. Of course, exact rate, like I said, will depend on the tenure of the FD booked. Okay, we have another caller joining us on the. Okay, Amar from Bengaluru is joining us on the phone line. Hi, Amar. Good evening. What's your query?
Good evening. I just wanted to know, according to current market situation,
yes,
are index funds are suggested to buy or not?
Index funds. Okay, yes. This is the first time that you will be investing, is it? And you're looking at index funds?
Yes.
All right. Yes. Okay. You want to invest in the long term, I'm assuming, right? Because
yes,
okay,
for long term.
All right. Okay. So Tarun, how would you help him out? A long term investor just starting his investing journey in the markets. How would you recommend he go about?
Yeah. Hi, Amar. Index fund, as we know, globally, they are very popular. And the reason for that is, as we know, as over a long period of time, the economic efficiencies become available to everyone. So in that case, the difference between an active and a passive fund manager reduces. In Indian case, we are yet to see the magic, but in the space like large cap, we are seeing that difference is getting lesser and lesser. So yes, index funds make a lot of strong case, and I would strongly recommend you to look at least a nifty kind of index fund to be part of your portfolio for a long period of time.
Part of your portfolio for a long period of time, and ensure, Tarun, that you invest in other funds as well, a mid-cap fund, a small-cap fund, especially since your time horizon is long. You need to diversify your portfolio. But again, don't go out there and buy 8, 9 mutual funds. You need to ensure that you don't over-diversify yourself as well, because a mutual fund is anyway a diversified product. You can always connect with us on the Money Show at etnow.tv, and we'll help you curate your portfolio. Okay, I think, do we have any more callers? Yes, okay. We have Ram Kumar from Indore. Ram, thank you for calling in. What's your question?
See, I just heard the expert say that corporate FDs are risky. But what about NBFCs which have long-standing, like Bajaj Finance, Mahindra, Sundaram Finance?
Yeah.
Are those high risk? They have been in the system for long, and
True.
Because he said it's very high risk. I was scary because I have invested in some of these companies for 3 years.
Yeah. True. A fair point, Ram Kumar. But, if you look at it, maybe 2 years ago, if you would have looked at DHFL, you would have thought the same, right? That, it's been a company that's been around for a long time. You've had some marquee celebrities as well, by the way, endorsing DHFL, but it did go belly up. ILNFS, similar situation. But anyway, Tarun, how would you advise Ram Kumar, with respect to his conundrum?
Yeah, so Mr. Ram, exactly the same answer I gave in the start, that yes, all these fixed deposit which you are talking about, these are the bluest of the blue chip in the market. They are AAA rated, and I don't see a challenge in these companies. But nevertheless, what I want to mean is the expectations need to be set very clearly, that tomorrow a corporate FD, in case a company goes for a bankruptcy, can post your bondholder. So you need to be clear about that part. Otherwise, like a bank, these AAA or the big NBFCs which you are talking about, there is no challenge as of now we see in them. So you can be rest assured, for at least for the timing on that. Yeah.
Okay. All right. You know, Tarun, I'll just have a follow-up question on that. You mentioned that if in case a viewer does not have time to research, etc., then maybe avoid a corporate bank FD, a corporate FD, pardon me. But let's assume that he does have some knowledge on you know, these companies, on individual names. So then how, Tarun, or what factors should one consider then when judging whether this corporate FD is worth putting money into then?
Right. So some of the filters I would put at is, first of all, the parentage of that company. What is the kind of parentage? A company with a long-term background as well as a strong parent gives you a lot of confidence. What kind of credit rating this corporate FD has currently? Anything about AAA rated, though we have seen accidents happening in that space also. So one should take it with a pinch of salt. Apart from that, yeah, parent, the processes, management, all matters a lot. So that's where corporate FD, you need to do a little more research compared to a normal FD, bank FD.
Email query that we have received, this one is from Varun Garg. Now Varun writes in saying, are there any tax benefits if one invests in a 5-year corporate fixed deposit, as is the case with a 5-year bank fixed deposit? If no, then which one will have better post-tax return on an average? Valid point, because just a refresher for all our folks out there, if you put your money in a 5-year bank FD, then you can claim the deduction under section 80C when you're filing your income tax return. So Tarun, is there any similar benefit for a corporate FD?
So tax on both, in case of corporate as well, bank FD will be taxed according to the income tax slab you fall under. So there is no arbitrage available there. But since corporate FD earns you better interest, so normally post-tax returns are better in that case. And there is a one point to note is there is a TDS anything above more than 10,000 rupees interest earned. So a TDS is something which will be deducted by the corporate FD company.
Okay, very important to note, a very valid question as well, because then at the end of the day, you want to know how much you're getting after all the tax payments done, etc. So it's a valid question over there, and that was Tarun's opinion. Okay, we have another email query from Mr. P. Bobby. He writes in saying, I'm 75 years old. I have 50 lakh rupees in the HDFC liquid fund. Should I move the fund to a short-term fund or any other fund? Well, quite a meaty chunk in a liquid fund. But again, you have to consider his age. He is 75. So Tarun, HDFC liquid fund, is this somewhere where he should park his money?
Again, the information given is very limited for me to make any judgment on that. But again, a quick pointer I want to give to him: if he doesn't require the money for more than 3 months, then he should, anything less than 3 months, he need to park the money in a liquid fund which he is currently parked into. But if he doesn't need that money for, let's say, 1 year or 2 year or 3 year, then he can probably look at a space called banking and PSU funds, in debt funds, which I find in terms of safety as well as return very lucrative currently, and they are best suited for retired people currently.
All right. Well, unfortunately, we'll have to, with that, shut shop on Ask the Money show. So we will have to carry forward the rest of the questions and queries on another show. Stay tuned to the Money Show. And of course, don't forget to keep sending your questions. Tarun, thank you then for joining us and very patiently answering all the questions and queries. Well, we'll do one thing. We'll take a very quick break right here on the show. But when we come back, we are going to be tackling very basic question as to what you should be doing if your bank, a public sector bank, is being merged with another public sector bank. What happens to your checkbooks, debit cards, credit cards, ATMs, etc.? That's what we will be discussing. Also, the fact that banks are being merged, we may be staring at a series of strikes due to unhappy employees. So how will that affect you is what we will be discussing just after this very short break. Hi everyone, welcome back. You're watching The Money Show on ET Now. After that in-depth discussion on corporate FDs, we are going to be getting into the nitty-gritties of banking operations. Now, I'm sure a lot of you guys have a savings account or a fixed deposit, or credit cards, debit cards with public sector banks. I'm talking about the likes of an Syndicate Bank, Canara Bank, Allahabad Bank, etc. And of course, we had FM Sitharaman announcing that some of these banks are going to be merged, and now we're going to be left with only 12 public sector banks. So you may be wondering, what am I supposed to do then if my bank is being merged with another bank? Hence, we on the Money Show decided to talk about how you can prepare yourself, at least in terms of documentation, if your bank is being merged. In fact, to take us through all of these nitty-gritties, I have with me right here in the studios Pankaj Bansal. He is the head of KM and other operations with bankbazaar.com. Pankaj, thank you for joining us on this show. Honestly, banking and all of these documentations pretty boring for a lot of people, but hey, all of us have those kits where our checkbooks are there, debit cards are there, credit cards are there, etc. Right? Yeah. But let's start off first with a savings account. Let's assume that I have a savings account with, let's say, a Syndicate Bank, which is going to be merged with Canara Bank. I have an FD as well, assuming. What happens next? And now that both the banks as well have given the nod for that merger, what happens to my savings account and my FD accounts?
So I think nothing will change from a consumer standpoint. All the interest rates or the deposit rates which are being done on the FDs and your loans will remain the same the way it is for the current year.
Okay.
Whatever change will happen is only happen after the maturity date of the fixed deposit. Okay. For example, the maturity date is 20th September 2020. After that, only the changes will be made to that particular thing. There is no pre-effective change for all these FDs and personal loans from that standpoint. If the consumer has an MCLR loan, it will continue till the date of the loan closure. And if it is a base rate loan, then obviously consumer will have a choice to take a base rate loan, convert into an MCLR.
Or he can continue with fixed as well.
Fixed deposits. So that's the way that will work even for loans and deposits. So there is no change for the consumer till the start.
So this would happen, let's say if I'm in Syndicate Bank and let's say the FD rate in Canara Bank may be lower or higher, even then I will continue with the same interest rate.
Right.
Okay, so very simple, there'll be no change in the returns that you will have. It's just that the nomenclature basically or the branding of your fixed deposit certificate will essentially change.
Absolutely.
What about all the documents then? You have your checkbooks, your debit cards, credit cards. What happens to all of that?
So what will happen is that till the merger is being done, you will continue to use all your credit cards and debit cards in the same structure with the same terms and conditions. There is no change in the terms and conditions. For example, there is a minimum balance which is required for a particular saving account. It will continue the same. There is a cash withdrawal limit for a debit card. It will also continue the same till the time the recarding is being done for the new product. So the banks will do a recarding with the new products, whether credit card or a debit card, post which only those changes will be made effective. Before that, nothing will change for a consumer standpoint. Everything will remain the same. Even the nomenclature for saving banks will remain the saving bank, or a current account will remain as current accounts.
So will I have to go over to the bank, by the way, then for a new set of checkbook leaves or a new card?
No. So what will happen is that you can just update your communication address with the bank. They will keep communicating with you. You expire your current inventory of all your products, which is your checkbooks or your credit card or debit card. Once the recarding is done, they will issue a fresh card and you can destroy your existing, say, your debit card or a credit card.
So it's not like, I will have to wait for a new checkbook to come and only then will I be able to issue.
You can use it till the time it is expired.
Till the time the checks themselves expire. Fair enough.
Yeah.
Okay, all right. Now, the problem that a lot of us face, we are living in a digital technology world, right? I do not need to every time call up my bank and say, okay, listen, issue the rental amount to my landlord or pay my electricity bill. It all happens automatically simply because you have your IFSC and your customer ID, bank account, etc. Everything updated with 10 different third-party entities, right? From your income tax department to maybe your landlord for that matter. Everyone has your details.
Correct.
Now, obviously, since you said the nomenclature will change, right? You'll have your IFSC that will change. Maybe your savings account number, etc. will change as well. What am I supposed to do then?
So what will happen is that first is important thing is that the KYC need not to change. You can use your current KYC with your existing bank. Whatever change will happen will be communicated like your IFSC code, customer ID or your account number. The new IDs and customer IDs will be communicated to you. What you'll have to do, there are 5 instances that you'd normally use it. One is your income tax department where tax refunds have been paid. So all that updation has to happen. Second is mutual fund redemption. So that mutual fund redemption has to happen. Third is, for example, insurance claims. So that also you need to update on the insurance websites. SI, which is your standing instructions / ECS, which is electronic clearing system mandates, that has to be updated. There are new cust IDs with your new account numbers and IFSC code.
Okay.
That's something that has to be done. Fourth is SIP, which is your SIP mandates.
Yeah.
That has to also get updated.
The investments
Investment
that we do.
mandates and your personal loan auto debit mandates.
Yeah.
Standing
The
instructions.
EMIs basically.
EMIs. That has to be updated once you get the new IFSC code, new customer IDs from the bank.
So this is a tedious process.
Absolutely.
You will have to go to each individual third party and tell them, hey, these are my new details.
Correct.
Okay. So sorry if I go, guys, there's no way out over there. We may have advanced technologically, but I
Correct.
suppose what has to be done still has to be done. You'll have to go to each third party, from your income tax department to perhaps that demat account, with where you are maintaining your SIPs, etc. And you'll have to tell them that, hey, these are my new IFSC codes, this is my new account number, and now you can carry out transactions through this account number.
Correct.
Okay, when we're talking about digital transactions and automatic transactions, a lot of us use internet banking, a lot of us use mobile banking, phone banking, etc. Now, if I am, let's say, a Syndicate Bank customer, I will log on to, Syndicate Bank's website and I will conduct my transactions.
Correct.
So, until this merger is complete, what is the status of net banking?
So, nothing will change again. You will use your existing credentials the way you are using it currently. Nothing will change from a customer standpoint. The only change will happen once your IFSC and customer ID, as earlier mentioned, will change. Obviously, this will redirect to your new website, which is into the merged entity, and consumers can log on for their products and online services directly to the new merged website. So, nothing from a consumer standpoint will change till the time the entire merger and the technological integration between all the merged entities has been done. So, I think post that only, that will redirect it to the new website which the merged entity will have.
Okay. Now, this is not the first merger that we are seeing. I mean, we had Bank of Baroda that absorbed Dena Bank and Vijaya Bank.
Correct.
Based on your experience, based on your interaction, did you see any teething problems that took place for the customers of these banks when the merger happened?
So, communication is a very critical aspect of this merger and acquisition. So, what happens is that if my addresses are updated, my email IDs are updated, my mobile numbers are updated properly in the system, there is no communication gap. The problem happens if I am a consumer and I have not updated my current address or my current mobile number. So, whatever communication happens through a merged entity does not reach me. Once it does not reach me, then there is a problem because I am not able to know my IFSC code, my SIs gets invalid. That's something that we have to take care and ensure that all our current updations on customer address, contact details, everything has to be updated with our branch, and that's how it has to be taken care of.
Okay. The other problem now is that, see, a lot of employees are not exactly happy with the PSB mergers, and hence you do have a couple of them going on strike. And the thing is, some of these strikes are planned for prolonged periods of time. Plus, you have a couple of holidays as well coming up, banking holidays. So, I think for the month of October, there are perhaps going to be a lot of non-banking days. In such a situation, what services will customers be able to use?
So, customers can use all their services except the services which are like issuance of DD, POs at the branch level. Anything which is related to the physical branches will get impacted because of the bank strikes. All your mobile banking operations, internet banking operations will work the way it is working currently. There is no change. One piece of advice that we'll give it is proactively consumers should plan for all their cash withdrawals, cash deposits to ensure that there is no slippages from that side. And third is, I think, use more and more digital transactions like UPI, RTGS or NEFTs, so that these services any which ways will not get impaired with the strikes. So that's, I think, the word of caution that I can give.
Okay. We were talking about the negatives when it comes to the bank merger, but I think we didn't talk about the positives, and that's the number of branches.
Correct.
I know a majority of our transactions do happen online, but then there are a couple of our viewers who still physically go to the bank and essentially, do all the paperwork, especially some of our older audiences. So I think the biggest benefit is, I suppose, the larger network of branches.
Absolutely, I think that's the basic benefit. If you look at the cultural that is being formed with these branches, most of the regional disparities have been taken care of. For example, Union Bank with Corporation. Union Bank is a West Zone bank, Corporation is a Karnataka-based bank, and Andhra, which is a AP-based bank. So I think the regional disparity, the number of branches, everything is a very positive measure from that standpoint. And I think in the long run, this consolidation will benefit the banking industry a lot.
Okay. Okay, fair enough. I hope, guys, this has given you a ready checklist of what all you need to do or don't need to do as well when your bank does get merged with another bank. I think the most arduous process is going to be informing all the third parties that, hey, listen, now my bank has been merged with another one. So this is what's going to happen. I just have one more follow-up question, but I think we don't have time anymore, so I'll have to call it a day. Thanks so much, Pankaj, for explaining this very simply for all our viewers. Well, folks, we'll take a very quick break right here on the show, but when we come back, we are going to be getting you a brief glimpse into LIC's new tech term plan, the second plan by LIC in just 1 month, and we'll also be talking to some big voices on the sidelines of the Morning Star conference. Hi everyone, welcome back. You're watching The Money Show on ET Now. We've got a very interesting conversation lined up. Did you know that almost every individual, you and me, have certain biases that do tend to affect the way we perceive the world, and that includes even the all-important topic of money. And that's when it becomes a problem, when your biases tend to get in the way of you earning wealth, maximizing your returns. And hence, we decided it was important to bring on board a very important guest who's done extensive research on this topic. Sarah Newcomb, she's a behavioral economist with Morningstar, and she's joining us, in fact, on the sidelines of the Morningstar conference. Sarah, it's a pleasure having you with us on Money Show. Thank you so much for joining us. Apart from biases and personal finance, behavioral traits, there's another very interesting topic that you have spoken about in your conference, and that is the importance of financial health. What exactly do you mean when you say financial health, and how important are behavioral finances?
Well, I think that behavioral finance has grown in its value over time, or at least in people's recognition of its value, as we see that our predictions of what people will do and what people actually do are quite different from one another. And this is where psychology becomes important, because our financial decisions are deeply rooted in our emotions and our psyche. And we can't divorce the fact that what happens to our money happens to us. And so when it comes to making financial decisions, financial health turns out to be a lot more than just having a lot of money. You can have plenty of money and still not sleep at night. But financial health is a combination of having economic security and having the ability to enjoy that economic security.
You have a lot of money, but you can't sleep at night. Like they say, money can't buy happiness, hence financial health. So Sarah, how should investors then consciously pay attention to their behavior in the market and sort of overcome all of these biases, or improve their chances at least of making money in the market?
It may sound overly simple, but our studies show that what's more important than market behavior is your behavior as an investor, and specifically saving. The biggest thing that makes a difference is contributing to your investment accounts. The market can go up 300%, but if you haven't contributed, you don't take advantage of that gain. So the biggest behavior to watch for is actually saving.
So what are the most common biases then, Sarah, an investor suffers from, especially us in India? What is the most common bias?
Some common biases that you may have already heard of are overconfidence. That's a big one. We all think that we're better than everyone else at playing the market. And the market is fun. But another bias would be present bias. And present bias is probably the most pervasive thing. Again, present bias keeps us from saving in the first place, because what happens is that in our mind's eye, the here and now are so much larger than the far off vague future that we're saving and investing for. And because of that, our mental cost benefit analysis gets skewed. And so we value the present more than we value overvalue the future, which means that a lot of us would prefer to spend in the present than we would to invest for the future. And so we have to do something to counter the effect of that bias.
Okay, so let's delve more into some of these biases. I'm sure when a trader is playing the market, is trading in the market, his biases will be different as opposed to, an individual investor who may be having another business or maybe salaried and is just investing via mutual funds. How do the biases of these two individuals differ?
So I think that when it comes to mutual funds, there is a tendency to treat them as if they were stocks and to trade them when new information comes available. But when you invest according to a mutual fund strategy, you've looked at the long haul and you're investing for the long term. And so this new information should be irrelevant to your investment plan because it was thought of before you invested in the first place. And so it's not a specific behavioral bias so much as it is just a tendency to treat any investment as if it were a stock.
Okay, I want to ask you specifically from an India perspective, Sarah, for Indians, what's your observation on the biases found? I mean, you mentioned overconfidence, perhaps too much risk aversion. What is it that Indians tend to suffer from then?
From what I've seen and heard in India, which is limited, of course, is a tendency to overvalue gold and real estate above any other kind of investment option. And gold and real estate are fantastic investment options, but they are only two, and there are many more. And in order to truly diversify your portfolio, you want to expand beyond that. So I would say it's a risk aversion, a type of risk aversion that manifests itself in only holding physical assets.
All right, and Sarah, of course, I must ask you this question then, and especially for all our viewers out there who are women who leave all the money matters to the men. Sarah, men or women, who can be better investors?
Well, this is a tricky question because most of the research does show that women tend to be better long-term investors. But I tend to think that human nature is human nature, and fear and desire don't limit themselves to one gender or the other. So we should all be aware of which of those forces is the most powerful in our own lives.
Okay, Sarah, it was a pleasure having you with us. Thank you so much for joining us on The Money Show on this very interesting conversation. It's important to understand the biases that you suffer from because it may be coming in the way of making you wealthy. On that note, we'll wrap it up in this edition of The Money Show. Thank you so much for watching.